This is a recording for Deferred Tax International Accounting Standard number 12. My name is Paul Jones Malawi, and displayed below are my contact details. The contact numbers, should you require my services, I'm available. A part-time online lecturer in accounting. To be exact, ACCA. And there's an advantage of one-on-one. The first advantage is that you're going to be able to ask questions and get an instant response. The second advantage is that if you're studying ACCA, I'm going to tell you the exam tips, having gone through the same journey and having seen some secrets. Because to pass exams, there are a number of things that you need to be acquainted with. The first one is an exam technique. You might have the knowledge, but if you don't know the exam technique and exam approach, you are going to be investing your money and you're going to be losing your money because you're going to fail. Be guaranteed that ACCA is not simple, especially when you go to the advanced level. The strategic papers, they're quite expensive. And it's important that when you're studying like that, you must pass on first attempt. If you fail on the first attempt, at least pass on the second attempt. Okay. So deferred tax, the key learning objectives today, I'm going to discuss with you that you should be able to apply the recognition and measurement of the deferred tax liabilities and deferred tax assets. And should be able to understand the recognition of current and deferred tax as an income or as an expense in P&L, and they should be able to discuss and apply the treatment of deferred taxation on business combination. Okay, so it's important that you get a good understanding of taxation because it's one of the key exam area. The examiner likes this area because it's complex in nature. And even in practice, it's a bit complex because there's a lot involved in taxation. So the basic principles of tax is that the current tax is the amount of tax payable to the tax authorities in relation to the trading activities of the current period. So for the businesses that are operating in a country, I'll give an example of Malawi, where I'm coming from. The Malawi Revenue Authority is interested to get as much tax as possible. So business operating within the jurisdiction of Malawi, they are liable to pay tax on the income that is generated within Malawi. So if it's making profit within Malawi, if a business is making profit within Malawi, it has to pay tax in Malawi because Malawi is a source base. So current tax is a tax that is calculated on income, statement of income and loss, statement of profit or loss. When the company makes profit, they deduct the tax before the profit is shared by the shareholders. Okay, so deferred tax is an accounting measure used to match the tax effects of transactions within the accounting period. So in summary, the tax expense of an entity is calculated as follows: current tax plus minus the movement in deferred tax. Okay, so we are going in with an example, we're going to understand what we mean when we say movement in deferred tax. Okay, you might have a deferred tax asset or deferred tax liability. In the following year, you may either have a deferred tax asset or liability. So the movement in between, you take the movement, add plus minus the current tax. That's what you recognize as an expense or an income in the statement of profit or loss. Okay. So accounting for current tax, what we're saying is that current tax is the amount expected to be paid to the tax authorities by applying the tax laws of the country and by applying the tax rates in place at the date of reporting at the year end. What is the rate that is enacted by the legislature? Okay, so current tax is recognized in the financial statement by posting the following entry. You debit the tax expense in P&L and you credit the tax payable in the statement of profit or loss. So current tax accounting is often based on the estimates, and the final amount payable is often not finalized until after the financial statements have been authorized for issue. Okay. Okay. So if the eventual amount paid is less than the estimate recognized in the current period's financial statements, then this will reduce the current tax expense in the next accounting period. So as we say that the current tax payable to the tax authorities is a combination of, one, the current tax for the period and the movement in deferred tax. So if the eventual amount paid to the tax authorities is less than the estimate recognized already in the current period's financial statements, then this will reduce the current tax because like the company overestimated the tax liability, the tax payable. Okay, I hope it makes sense. So if the eventual amount paid is more than the estimate recognized in the current period's financial statements, then this will increase the current tax expense in the next accounting period. So the expense is deferred to the next accounting period. Okay. So they need to provide for deferred tax. Some differences between accounting and tax treatments are permanent, and that is fines and political donations, and the determined costs would be expensed to the statement of profit or loss, but are normally disallowed by the tax authorities. Therefore, these costs are eliminated or added back in the company's tax computation. I should say that using accounting standards, the accounting standards may allow some expenses to be recognized in the statement of profit or loss. However, in some jurisdictions, some countries, they may not allow some expenses like fines. Fines, if you donate to a political party, even though the political party is registered, the tax authorities, they do not allow that because it's easy to beat the system. It's easy to beat the system if it can be allowed in that case. So fines come because of management complacency. So it can be a statutory fine, it can be a police fine, it can be a fine that comes due to non-compliance of in some nature. And those fines in accounting treatment, they are expenses, but for tax purposes, they are disallowed or non-allowable expense. So what happens when you're calculating the current tax? The taxman will come and take your statement of income and loss, your statement of profit or loss, the profit, and they add back all expenses that are non-allowable to arrive at an amount that is called amount for assessable income, okay, or the amount for tax purpose. You understand? Okay, so some differences between the accounting and tax treatment are temporary, and that is to say capital assets might be written down at different rates for tax purposes than they are in the financial statements. Where I'm coming from in Malawi, we've got the do not allow depreciation, accounting depreciation. Accounting depreciation is an allowable expense because it's an assumed expense. and they provide what is called capital allowances. Okay. In some countries, there are tax rates that are applicable to different assets, and depending on the usage and depending on the law enacted for a specific asset. It may be 40, 20, 20, 10 ratio, or sometimes 100%, depending on the type of the asset. So it's really important to understand the tax laws in the jurisdiction in which the company is operating, in order to be fully acquainted in as far as issues of tax are concerned. Okay. So temporary differences may mean that the profits are reported in the financial statements before they are taxable. And conversely, it might mean that tax is payable even though profits have not been reported in the financial statement. So we should understand that there are permanent differences that may arise, and there are temporary differences. So with examples in the preceding slides, we're going to see how that is accounted. So according to the accrual concept, the tax effect of a transaction should be reported in the same accounting period as the transaction itself. Therefore, an adjustment to the tax charge may be required, and this gives rise to a deferred tax. Taxman is saying, if there are temporary differences, some taxes should be deferred because of those differences. But the accounting accrual concept, the accounting concept is saying, recognize the expense as and when it occurs. You understand? But generally, in practice, it might not be like that. So that's why tax comes in with a law, so that there's uniformity on the treatment of transactions. Okay? So deferred tax only arises on temporary differences. That is to say, it is not accounted for on permanent differences. Okay? A temporary difference is the difference between the carrying amount of an asset or liability and the tax base. What do we mean when we say tax base? You know what a carrying amount is, and an amount at which a transaction is carried in statement of financial position, or in the statement of income, and in the statement of profit or loss. Okay, so if there's a difference between the carrying amount of that asset and the tax base of that asset, a taxman will come with an amount which is called a tax base. If there is a difference in between, that's when a deferred tax is recognized. Okay, is identified and recognized. So a tax base, as we're saying, is an amount attributable to an asset or liability for tax purposes. Okay, let's give an example. Prudent prepares financial statements to 31 December each year. On 1 January 20 Excel, the entity purchased an current assets for 1.6 million that had an anticipated useful life of 4 years. The asset value is 1.6 million. The expected useful life is 4 years. So depreciation per year, we take 1.6 divided by 4 years, and we'll see how we can account for this. So this asset qualified for immediate tax relief of 100% of the cost of the asset. Okay. So for the year ending 31st December 2020, the draft accounts showed a profit before tax of 2 million. Very important. Profit before tax of 2 million. The directors anticipate that this level of profit will be maintained for the foreseeable future. If it's going to be maintained, it means every year the company is expected to make a profit of 2 million. Okay. Prudent pays tax at a rate of 30%. Okay. Apart from the differences caused by the purchase of the non-current assets in 20XL, there are no other differences between the accounting profit and taxable profit or the tax base and the carrying amount of the net assets. So required, important, compute the pre and post-tax profits for Prudent for the year, for each of the 4 years ending 31st December, 20X0 to 20X3, inclusive, and for the period as a whole, assuming A, that no deferred tax is recognized, and B, that deferred tax is recognized. So the first one, no deferred tax. The second one, deferred tax is recognized. Let's see how we're going to deal with this question. So what I did was to copy the same information in Excel so that you should be able to calculate given the question. So here is a question in Excel, and let's see how we're going to deal with it. We know for sure, for a fact, that the company year ends in on 31st December. So how many years do we have here? The same 20XL to 20X3. So we're gonna say 20XL, 20X1, 20X2, 20X3. Okay. Then we're gonna see how much will be the total. All right, so let's break down the question in a way that we can easily follow and understand. Okay, so for the year ending 31st December next year, the draft account showed a profit before tax. So this is accounting profit. Remember, we are answering the first question that no deferred tax is recognized. All right. Accounting profit before tax. Yeah, we are given that is 2 million every year. So let's do this. It should have a precision of $1,000. Okay. So if a company is making 2 million before tax, gonna say 2,000, 2 million, and copy paste. Then here you got total. So by the end of 4 years, the company would have made a profit of 8 million. Okay. So what we need to add back is depreciation. Remember, in accounting, we're using accounting depreciation, and depreciation is not allowed for tax purposes. So how much will be depreciation? Working number one. Working one. So assumption is that a straight line is used. That is to say, the asset value is 1.6 million. Okay, precision. Then 1.6 million, the useful life is 4 years. So every year, the company is charging depreciation of 400,000. We take 1.6 million divided by 4 years, and our depreciation is 400,000. So what I'm going to do is to copy the 400,000 evenly. Okay. And enter. So this is depreciation. Add back accounting EPN. Okay. What else do we need to account for? So remember that this asset qualified for immediate tax relief of 100% for the cost of the asset. Okay, that one is allowances, is capital allowance. So what you're gonna do is we're going to deduct 100% capital allowance on the value of asset. That is 1.6 million. Okay, so it's gonna be a reduction 1,600. So it means that in the second year there was nothing, third year there was nothing, in 20x3 there was nothing. So the total is minus 1,600. So as you can see here, the accounting depreciation, the total accounting depreciation at the end of 4 years is 1.6. The taxman allowed 100% deduction in the first year. So it means that the total account depreciation matches with the total tax depreciation. So taxable profits is going to be sum total of the above. So 800 in the first 20 Excel and 2,400 in 20x1 and 2,400 in 20x2, 2,400 in 20x3. So the total profits is 8 million. So let me put a line here. Okay. Put in board. So what else do we need to account for? We need to account for tax. Okay, so these are the taxable profits. We need to account for current tax. Current tax at 30%. Okay, so what are you gonna say? It's 800 times 30%, 240 in 20 Excel. I'm gonna copy the formula and 720 profits, current tax in 20x1 and 720 in 20x2, same with 20x3, and the total is 2,400,000. Okay, I hope that makes sense. So what you can remember is that, or what you should remember is that the differences between the accounting profit and taxable profit that occur from 1 year, to the other. So what we're saying is the difference between the accounting profit and taxable profit that occur from 1 year to the other cancels out. Okay, what I'm trying to say is that even though the taxman or the tax authority allowed for deduction of, allow the tax allowances to the company of 100% in the first year, and nothing happened between the years of 20x1 to 20x3, okay, the overall tax profit matches. Taxable profits is 8 million here, and taxable profit, the accounting tax profit is 8 million here. So that's what we're trying to say. Over the years, if you take the total, the result will be the same. But there's gonna be an impact if you're using now deferred tax. If you're incorporating deferred tax, the result will be different. So obviously, let's look at this one. We're saying that profit before tax. Let's just copy this one down here. Profit before tax over the years is 2 million. Okay. And if we copy down the current tax, let's just say current tax payable. It's this one here, calculated already. So I'm gonna copy and paste it here. So what we're gonna end up having is profit after tax. So what we're saying is that profit is 2 million minus 240. It's gonna be 7060. And I'm gonna copy down the formula over the years. Okay. The total of this one is 5,600, and the total profit 8 million, and the total taxes is 2,400. Okay. So ignoring the deferred tax produces a performance profile that suggests a decline in performance between 20x0, okay, and 20x1. We're seeing a decline here because we've ignored deferred tax. Okay, so we've answered A, and let's attempt B, that deferred tax is recognized. How are we gonna do that? Let me copy this and paste it here. So this is our B. That one is A. Okay, tax is very exciting. When you start to understand the tax in itself, and you're given a chance to understand the tax itself, you find it very exciting. Though it's difficult, but it's doable. So it's doable. There's no rocket science in accounting. Everything is doable. Okay, so the carrying amount of the asset, that's where we're starting from. The carrying amount of the asset that's where we're starting from. Remember, the company bought this asset at 1.6 million. So in year one, they're gonna have 1.6 million. Okay, let's put the precision. Precision of dollar. Let me just copy this one. Precision, copy and paste. Okay. Remember that the carrying amount of an asset in year zero is 1,600,000. So in 20x1, the carrying amount is going to be 1,600 minus depreciation. Remember, we said every year the asset is being depreciated 400,000 minus 400,000. In year 2, so what I was saying is that the carrying amount of an asset by the end of year 1, it has already depreciated by 400,000. The 400,000 is a depreciation for 20x0. So I'm going to remove 400,000. Then I'm also going to remove 400,000 depreciation for year number 20x1. Okay. So the carrying amount in 20x1, by the end of 20x1, is going to be 800. By the end of 20x2, it's going to be 800 minus 400,000. Okay. That is to say, by 20x3, it's going to be 400 minus the depreciation for that year, 400. Okay. Then it's got a nil value. However, the tax base of the asset, we are not given in the question. Okay. We are not given here in this question. If we are given in the question, you could have put a tax base there. Okay. So we assume that the tax base is 0, 20x0, 0, so as in 20x3. So the temporary differences between the two is going to be, so temporary differences is going to be the carrying amount of an asset minus the tax base. So 1.6 in 20x0, I'm going to copy the formula down, and these are the temporary differences. What are we going to do with these temporary differences? Or what effect are these temporary differences causing? The carrying amount is more than the taxable amount, or the tax base, sorry. That creates a deferred tax asset. Okay. So what is saying is tax rate applied is 30%. So if we take 30% of 1.6, it's gonna be so here we're supposed to take 1.6, the carrying amount minus depreciation for that year, and that is 400,000. Okay, we forgot to do that. It means here we're gonna remove 400,000. Okay. So applying the tax rate, 1.2 times 30%, that is 360. I'm gonna copy the formula across. Okay. The tax liability, 360, 240, 120, and 0. Okay. What are you saying that we also need to account for the total tax? What are you saying is that the opening tax in year 1, we had nothing, but by the end of year 20x0, we had a balance of 360 negative. That is to say 360 minus 0. Okay, we had an asset of 360. So what we need to do is the 240 tax liability has to be subtracted by the 360 to have a balance of 120 negative. Okay. So what I'm trying to say is that the opening deferred tax, deferred tax, 360 here is going to be 120 plus 120, that is to say 240 negative. Okay. So if we take 120 plus 240 negative, gonna have 120, and that's gonna be the opening for this year. And here is gonna be 120 negative. Okay. Let's have an extract of P&L. The state, like a reconstruction, more or less, yeah, more or less a reconciliation. What we're saying is that the statement of profit or loss for the 4 years, 20x0 to 20x3, including deferred tax is as follows. Okay, gonna copy down the years on 20x0. Then what we're saying is profit before tax as calculated. Profit before tax, that's an accounting profit of 2 million every year. You have a total of 8 million. Some total 8 million. Then we've got the current tax charged. Current tax for the year. Yeah, we calculated here the current taxes. This 240 times -1. I'm gonna copy down the formula. And the numbers already given. Now we've got the deferred tax. Deferred tax as calculated above. What you're gonna say is 360 times -1. And I'm gonna copy the formula. Okay. Negative shall mean what? Liability, and positive shall mean what? Deferred tax asset, deferred tax income and deferred tax expense. That's the meaning of that. So let's have a total here. It's gonna be 1.4. And the total for the above 5.6. Okay. So a more meaningful performance profile is presented when you take into consideration the deferred tax than here, where there's more or less a bias reporting. So which one would you prefer, to incorporate deferred tax or not to incorporate deferred tax? Because if you incorporate deferred tax, there's paying more money. That's why a taxman would come and prefer that you use the tax law in order to incorporate, because it gives more meaning than otherwise. Okay. So I'm gonna share back the presentation to continue from where we stopped on the current slide. Okay, we've seen the example. This is the solution. There it is. is 1.6 depreciation. Here's a tax allowance as we calculated, and the taxable profits as we calculated. The current tax rate as we calculated, 240, 727, 20. And the 5,600 as we calculated. There is a narration. Okay. There is a charge of credit to P&L, and there is B. So what it's saying is that a more meaningful performance profile is presented. 1,400 evenly. The profit after tax is 1,400 evenly for the 4 years. Okay. So examples of the temporary differences include, but not limited to, the tax deductions for the cost of non-current assets that have a different pattern to the write-off of the asset in the financial statements. So as I said already, that in accounting we use depreciation. Okay, we use depreciation for accounting purposes, but a taxman will come and give you the tax depreciation. So there might be differences between the accounting depreciation and the tax depreciation, how you write off the value of the asset, or how to recognize a depreciable amount, and so on and so forth. So that element of temporary differences as we calculate the area creates deferred tax. Pension liabilities that are accrued in the financial statements but are allowed for tax only when the contributions are made to the pension fund at a later date. That also may create a temporary difference. There may also be intergroup profits in inventory that are unrealized for consolidation purposes, yet taxable in the computation of group entity that made the unrealized profit. Remember, when there's a trading between the related parties in the group at the year end, there may be some inventory that are not sold. Okay, that creates an element of unrealized profit that are sold between the parties of the group, but payment is not yet made. It creates an element of unrealized profit in the inventory. A loss is reported in the financial statements, and the related tax relief is only available by carry forward against future taxable profits. That also creates an element of temporary differences. Assets are revalued upwards in the financial statements, but no adjustment is made for tax purposes. That also creates an element of temporary difference. Development costs are capitalized and amortized to profit and loss in the future periods, but were deducted for tax purposes as incurred. The cost of granting share options to employees is recognized in profit and loss. However, no tax deduction is obtained until the options are exercised by the people that are given those options. Could be executives, could be employees. So how do you calculate the temporary differences? Deferred tax is calculated by comparing the carrying amount of an asset or liability to its tax base as you calculate area. The tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to the to an entity when it recovers the carrying amount of that asset. So if those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount, so that the temporary difference is nil. So the tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in the future periods. In the case of revenue, which is received in advance, the tax base of the liability is its carrying amount less any amount of the revenue that will not be taxable in the future periods. Okay. So it may happen that the carrying amount of the tax liability and the taxable amount for tax purposes is different. That's where an element of temporary differences arise. So if you apply the rate to the difference, that's when you have deferred tax liability. Okay. If the carrying amount exceeds the tax base, the temporary difference is said to be a taxable temporary difference, which will give rise to the deferred tax liability. If the tax base is more than the carrying amount, the temporary difference is a deductible temporary difference, which will give rise to a deferred tax asset. Okay. International Accounting Standard number 12, income taxes, states that deferred tax should be provided for on all taxable temporary differences, unless the deferred tax liabilities arises from, number one, goodwill, which amortization is not tax deductible, or the initial recognition of an item that affects neither accounting profits nor the taxable profit, and which does not result from any business combination. Otherwise, the temporary difference has to be accounted for, and the tax on the temporary difference has also to be accounted for. So deferred tax assets should be recognized on all deductible temporary differences unless the exceptions above, the two exceptions above apply, or insufficient taxable profits are expected to be available in the future against which the deductible temporary differences can be utilized. It may happen that there may be an estimate of a loss-making business. So if you make losses for a cumulative period of, in some countries it's 3, in some countries 6, you should not recognize the temporary differences or the tax on the temporary differences. Okay. So measurement, the tax rate in force or expected to be in force when the asset is realized or the liability is measured should be applied to the temporary differences to calculate the deferred tax balance. So International Accounting Standard number 12 specifies that this rate must be based on legislation enacted or substantively enacted by the reporting date. That is very crucial. And it's crucial because examiners, SBR examiners especially, they like that. Even F7 examiners, they like to bring in a case where you need to apply several standards. In that case, where the tax law was enacted after the balance sheet date, before the financials are approved, which takes precedence. So it's based on applying the rule. Okay, deferred tax assets and liabilities are not discounted to present value. Do not discount. Do not discount the tax assets and liabilities. Do not apply a discounting factor. Okay, that's a rule. It's a rule. You need to follow the rule. The entry to profit or loss and other comprehensive income in respect of the deferred tax is a difference between the net liability, that is the asset, and the beginning of the year, and the net liability at the end of the year. Okay, it is important to note that the item giving rise to deferred tax is dealt with in profit or loss. The related deferred tax should also be presented in the profit or loss. If the item that is being dealt affects the P&L, account for the deferred tax asset, deferred tax effect on the profit or loss. Don't take issues of the profit or loss to the balance sheet. It's inconsistent. Okay. If the item giving rise to the deferred tax is dealt with in other comprehensive income, the related deferred tax should also be recorded in other comprehensive income and held within the equity presentation. Deferred tax liabilities and assets are presented as non-current assets, as non-current on the statement of financial position, whether asset or liability. Okay. The standard notes that deferred tax assets and liabilities can be offset as long as, number one, the entity has a legally enforceable right to set off current assets and current liabilities. That's the only time when the offsetting of assets and liabilities is done. I think also in IAS 19 we offset liability and asset. Those are instances when you offset. So the deferred tax asset and liabilities relate to tax levied by the same tax authority. Okay, so let's test your understanding now. Question: BRIC is a company with a reporting date of 30 April 2024. The company obtains a tax relief for research and development expenditure on cash-paid basis. The recognition of the material development assets during the year in accordance with IAS 38 created a significant taxable amount differences at 30th April 2024. So the tax rate for companies as at the reporting period was 22%. Okay, 22% at the reporting period. On 6th June 2024, the government passed a legislation to lower the company tax rate to 20% from 1st January 2025. Question required: explain which tax rate should have been used to calculate the deferred tax liability for inclusion in the financial statement for the year ended 30th April 2024. So the issue of dates in accounting is very crucial. Dates plays an important role in accounting transaction. So if you ignore dates, you are pushing yourself to failure. Okay, this company has got a reporting date of 30th April 2024. The question is for us to explain which tax rate should have been used. There are two rates here, 22% and 20%. 22% was the rate that was there at the year end, and 20% was enacted on the 6th of June. Okay, but this rate will be infected on 1st of January 2025. So which rate should be used? That 22% or 20%? So what we're saying is that the deferred tax liabilities and assets should be measured using the tax rates expected to apply when the asset is realized. First, that's the first point to note. So this tax rate must be enacted or substantively enacted by the end of the reporting period. Okay. Another fact is that in this question, the government enacted 20% tax rate after the year end. And therefore, it should not be used when calculating the deferred tax liability for the year ended 30th April 2024. Okay, the current rate of 22% therefore should be used to calculate deferred tax. If we are to apply IAS 10 events after the balance sheet date, changes in tax rates after the end of the reporting period are an adjusting event. So that's a complement to my assumption of using the 22%. However, if the change in the tax rate is deemed to be material, then the company, which is BRIC, should be able to disclose, okay? Should be able to disclose this rate, the change in the rate, and an estimate, and the estimate of the financial impact of using the rate that it has chosen to use. Okay, that's what we're saying here in the solution. Okay, the rate to be used is 22%. Specific situations, revaluations. Deferred tax should be recognized on the revaluation of property, plant, and equipment, if and only if there is no intention to sell the asset. So if you revalue on the basis that there's a need to revalue, you should incorporate deferred tax. But if you revalue with the intention to sell, no deferred tax. Any tax due on the gain made on any sale of the asset can be deferred by being rolled over against the cost of the replacing the asset. So revaluation gains are recorded in other comprehensive income, and so any deferred tax arising on the revaluation must also be recorded in other comprehensive income. An example, an entity, Dodge, owns property, plant, and equipment that costs $100,000 when purchased. Depreciation of $40,000 has been charged up to the reporting date of 30th March 2021. The entity has claimed a total tax allowance on the asset of $50,000. On 31st March 2021, the asset is revalued to $90,000. The tax rate is 30%. Explain the deferred tax implication of the situation. Okay, questions like this are very crucial and we must understand. So first of all, what we need to understand is that the carrying amount of the asset now is how much? Is 90,000 here. So the tax base is how much? The entity has claimed total capital allowance of 50,000. So if you take 100 minus 50, the tax base is 50,000. Okay. So carrying amount of 90 minus 50,000 will have a balance of 40,000. Now, if we apply the tax rate of 30% on the $40,000 balance, how much will be our tax? So if you take 30% of 40,000, that is almost $12,000. That's our deferred tax liability. Okay. So prior to the evaluation, before the evaluation happened, the carrying amount was $60,000. The asset was then revalued to 90,000. Therefore, if we take 90 minus 60, why are we saying it was 60,000? Because the equipment cost was 100,000. If you remove depreciation of 40,000, you have, at the date of revaluation, you have the carrying amount of 60. So the difference between 90 and 60 creates a temporary difference that relates to the revaluation. So the revaluation gain recorded in other comprehensive income, and so the deferred tax relating to the gain should also be recorded in other comprehensive income. Okay, so if you take 30% of 30,000, I will have deferred a temporary difference of 9,000. Okay. And how are you going to account that? And you're going to debit other comprehensive income, 9,000. And the difference between 12,000 and 9,000, that is 3,000, should be accounted for in the profit or loss. That's a basic explanation that I can put on that. Okay. Here is what we were trying to say. Carrying amount of an asset, 90. Tax base, 50. That is 100 minus 50. Leaving a carrying amount that exceeds tax base by 40,000. Creating a tax liability of 12,000. That is 30% times 40,000. Okay. Prior to the revaluation, the carrying amount was 60. As we saw, the asset was then revalued to 90. 90 minus 60, 30,000. And we need to take 30% of 9,000. Sorry, 30% of 30,000, giving us 9,000. So here is the accounting entry. The balancing figure 3,000 goes to as 6,000 expense in P&L. Okay. The balance on the reversion reserve with other components of equity will be 21. That is 30,000 gain minus 9,000 deferred tax. Okay. Share option scheme. Accounting for share option schemes involves recognizing an annual remuneration expense in profit or loss throughout the vesting period. Tax relief is not normally granted until the share options are exercised, as we saw earlier. The amount of tax relief granted is based on the intrinsic value in the options. The difference, that intrinsic value is the difference between the market price of the shares and the exercise price of those options. So this delay in tax relief means that equity settled share-based payment schemes give rise to a deferred tax asset. So the following pro forma can be used to calculate the deferred tax asset arising on equity settled share-based payment scheme. You know, shares can be sold in different methods. One of the methods is that shares can be sold on cash. You take your cash, go to Johannesburg Stock Exchange, you pay your cash, they'll give you shares. Sometimes in a company, there are share options. The executives want, or the employees are given an option to buy shares. Okay. And there might be normally there's an agreement between the owners of the company and the executives to say, if you are to stay in our company for the next 6 years, we're gonna give you shares at such a date, at such a date, at such a value. So you need to fulfill the obligation before you exercise your right to the options. Okay. So here's a pro forma carrying amount of share-based payment, and we reduce with the tax base of share-based payment. Then you apply the rate to find whether there's a tax liability or tax asset. So the tax base is the expected future tax relief based on the intrinsic value of the options that has accrued by the reporting date. Let's see a question. Splash. An entity, Splash, established a share option scheme for its 4 directors. This scheme commenced on 1 July 2008. Each director will be entitled to 25,000 share options on the condition that they remain with Splash, the company, for 4 years from the date of the scheme was introduced. Information regarding the share options is provided below. Fair value of the option, grant date is $10. Exercise price option, $5. The fair value of the shares at 30 June 2009 was $17 per share. A tax deduction is only given for the share options when they are exercised. The allowable deduction will be based on the intrinsic value of the option. Assume a tax rate of 30%. Okay, so required, that's the most important thing to note. Calculate and explain the amounts to be included in the financial statements of Splash for the year ended 30 June 2009, including explanation and calculation of any deferred tax implication. I said already that in accounting questions, dates are very fundamental. So you need to be very cautious with the dates. All right. If you fail to identify the accurate date, you may miss the whole concept. So in this question, there's a bit of calculation and there's a bit of explanation. So I'm just going to explain because of time, and given time in the near future, we're going to deal with the same, and I'm going to show you how we calculate. So the first thing to note is that the expense recognized for equity settled share-based payment scheme is calculated based on the fair value of the options at the grant date. That's the first point to note. At the grant date, the date at which the options are granted, how much was the share value? This expense is spread over the vesting period. Vesting period is a period at which the directors are given to stay with the company. Okay? And at each reporting date, the entity should reassess the number of options expected to vest. So in this case, the expense for the scheme is the year ended 30 June 20X9. Okay, that's the date when the options will be exercised. So that is to say, if we take 4 directors, okay, multiply by 25,000, multiply by $10, the option grant date, that's year 1, times 1 year over 4 years. We're gonna find the value to be 250,000. If you take 25 times 4, that's already what? 25,000 times 4, 100,000. 100,000 times 10, that's 1 million. 1 million divided by 4, that's 250,000. Yeah. So for tax purposes, what we're saying is that the tax relief is allowed based on the based on what? Based on the tax relief is based on the intrinsic value of the options at the date they are exercised. At the reporting date, the shares have a market value of $70. Okay. So, but the options allow the holders to purchase these shares for $5 at the exit date. So the difference between 17 and 5, that is 12, gives a rise to temporary difference. Okay. So long and short, what we're gonna do is we're gonna calculate the carrying value of the share-based payment. That is 4 directors. 4 directors times 25,000 times 12, that's 17 minus 5, times 1 over 4, 1 year over 4 years. You're gonna find it to be 300,000. Okay. So if you are to apply the tax rate of 30% on 300,000, you're gonna find the answer to be 90,000. Okay, where the amount of the estimated future tax deduction exceeds the accumulated remuneration expense, this indicates that the tax deduction relates to partly to the remuneration expense and partly to the equity element. So in this case, given all facts, in this case, the estimated future tax deduction is 300,000, and therefore 50,000 of the temporary difference is deemed to relate to the equity element, and the deferred tax relating to the equity element should be credited to equity. That is to say, we are going to debit deferred tax asset with 90,000 as we found it at 300,000 times 30%, and we're going to reduce we're going to credit equity with 15,000. That is the 50,000 difference times 30%, and we're also going to credit profit or loss with 75,000. That is 30% of the 250,000 that we found area. If we take 75,000 plus 15,000 on the credit side, we're going to find it that the credit side is going to have 90,000. On the debit side, that is on top the on deferred tax asset, also is going to have 90,000, making it balance. Okay. Right, that's the end of our discussion today, and I hope that the explanation I've put forward to you is going to go a long way in as far as deferred tax is concerned, and in as far as IAS 12 is concerned. I wish you all the best in your standards, but I should also mention that practice is very essential. When you learn like this, go back in the book, get a question, practice, get a question paper. Most of these SSA question papers have good answers. Get a question paper, attempt, and try it on your own with time, and find, when you calculate, compare with the examiner's answer, and get yourself how far you're going. All right, otherwise, I wish you all the best. Good luck.